Today, we're diving into an exciting topic that could change the way you think about trading cryptocurrencies. Specifically, we're talking about going long or short on crypto and how you can potentially make profits, whether prices go up or down. In the simplest terms, going short means you're betting that the price of a cryptocurrency, like Bitcoin, will go down. Instead of buying Bitcoin on spot markets, you use margin trading, meaning that you borrow it from an exchange and sell it immediately. Your aim is to buy it back later at a lower price. But what if you think the price is going to increase? That's where longing comes in. When you long an asset, you're buying it at one price, hoping to sell it at a higher price later. This is what most people are familiar with from regular spot trading. But here's where margin trading adds a twist: leverage. Leverage allows you to control a larger position than your initial investment. So, instead of just trading with your original $100 for instance, you can control a much larger position, say, $500 or even $1,000, depending on the leverage your exchange offers. But remember, leverage magnifies both gains and losses. To make these concepts easier to understand, let's check the following examples. For the purposes of this video, we'll be using Kraken, which supports margin trading for all major cryptocurrencies and supports leverage of up to 5x. Now, let's say Bitcoin is trading at $60,000. You believe it's going to drop, so you borrow one Bitcoin and sell it. If Bitcoin falls by 50% to $30,000, you buy it back, return the borrowed Bitcoin to the exchange, and keep the $30,000 profit. Minus fees and interest, of course. Now, that's the ideal scenario. But remember, if Bitcoin rises instead of falling, you're in trouble. You'll have to buy it back at a higher price, and that's where losses can get out of control if you're using high leverage. Now let's talk about going long. Longing means you expect the price of Bitcoin or some other cryptocurrency to go up. So, you borrow funds from the exchange to buy Bitcoin and sell it later at a higher price. Let's say you have $1,000, and you're using 5x leverage. That means you control $5,000 worth of Bitcoin. If Bitcoin is trading at $50,000, you can now buy about 0.1 BTC. If Bitcoin rises to $60,000, you sell your share of BTC for $6,000. Subtracting your initial $5,000, you've made $1,000 in profit. Just like with shorting, if the trade goes the other way, if Bitcoin drops instead of rising, you could lose your initial investment and even more, depending on your leverage. So, always be careful with margin trading and use stop losses to manage your risk. In addition to Kraken, there are many other crypto exchanges that support margin trading, many of which offer higher maximum leverage than 5x. Some of the more notable examples include Binance, KuCoin, OKX, and Bybit. There are also enticing welcome bonuses for new users available, so make sure to check the links in the description for exclusive bonuses of up to $5,000. Remember that we've covered only the mere basics of longing and shorting crypto in this video. So make sure to start small, use low leverage, and don't forget to practice risk management. As you build up your knowledge and confidence, you can start slowly increasing your market exposure and practice riskier trades. If you're just starting out in crypto and you're having trouble getting your money off a crypto exchange, check out our beginner guide on how to withdraw funds directly to your bank account.